Imagine you earn 50,000 rupees a month. You spend 30,000 on living costs, saving a disciplined 20,000 rupee surplus. Let's assume your employer gives a 10% salary hike every year. Over 20 years, that consistent saving adds up to 1.7 crores. At age 50, you've hit your goal. You have a massive cash pile and you're ready to stop working forever. This chart shows that 1.7 crore pile against your actual cost of living, which generally rises by about 8% every year. Because your expenses compound on top of themselves, that 1.7 crores is exhausted in exactly 8 years. By year 28, the strategy of hoarding cash leaves you with literally no savings to fund the rest of your life. The force that drained those savings is inflation, specifically the Consumer Price Index, or CPI, which tracks the price of goods at the retail level. Inflation is deceptive because it compounds. An 8% increase this year is calculated on top of the already higher prices from last year. This constant price hike erodes the purchasing power of your money, meaning a stack of cash buys less and less every single day. Keeping your wealth in cash surrenders it to an invisible tax that grows every year. Naturally, you might try to protect that money in a safe bank deposit, moving it into fixed income instruments. These instruments usually offer a steady yield, historically ranging between 8 and 11%. To outrun the cost of living, capital must move away from the illusion of guaranteed yields and into higher growth assets like equities. Let's look back at our 30-year-old worker saving that same 20,000 rupee monthly surplus. Instead of keeping the cash idle, we'll invest that surplus into an option that yields a 12% annual return. By year 20, the portfolio reaches 4.26 crores. That is 2.4 times more wealth than the cash strategy, achieved without increasing the monthly savings amount by a single rupee. Compounding investment returns offer the only way to counteract the compounding growth of your living expenses. Higher returns from equities do come with volatility, the risk that your investment value will fluctuate. Long-term investors like Warren Buffett accept this volatility as the necessary trade-off for growth. Market volatility is a short-term risk, but inflation is a documented outcome that destroys the value of idle cash over decades. Investing in the stock market functions as a defensive shield for your long-term financial survival.